Navigating Complex Investment Income. A guide to tax filing in 2024, many Americans now supplement their primary income with side hustles, investments, or real estate, resulting in complex tax situations that require careful planning. Simply relying on standard tax software or a yearly visit to a preparer may not be enough to ensure accurate filing and maximize potential deductions. This guide breaks down the key rules for reporting various investment incomes and offers strategies to potentially lower your tax burden. The rising complexity of modern income. Over 1/3 of Americans now earn income from sources beyond traditional employment. This includes income from investments, stocks, crypto, real estate, or entrepreneurial ventures. This shift demands proactive tax management, not just reactive filing. Poor record-keeping is the biggest mistake individuals make, potentially leading to IRS penalties or missed deductions. The IRS doesn't forgive ignorance. Failing to file, even if you assume no profit, can result in substantial failure to file penalties that accrue over time. Accurate reporting and thorough record-keeping are essential. Capital gains, short-term versus long-term, when selling assets like real estate, stocks, or cryptocurrency for a profit, you're subject to capital gains tax. The rate depends on how long you held the asset. Short-term gains, held for 1 year or less, are taxed at your regular income tax rate, just like your salary. Long-term gains, held for longer than 1 year, may be taxed at lower rates, potentially as low as 0%. The IRS calculates gains and losses as a net total. For example, if you have a $6,000 long-term gain and a $4,000 short-term loss, only $2,000 is subject to long-term capital gains rates. The long-term capital gains rates are as follows. Income filing status, rate up to $48,350 single. Married filing separately 0%, up to $64,750 head of household. 0% up to $96,700, married filing, jointly 0%, $48,351. $533,400, single 15% collectibles, and qualified small business stock, QSBS collectibles, art, wine, jewelry, are taxed differently. Long-term gains are capped at 28%, while short-term gains follow your regular income tax rate. Qualified small business stock, QSBS, offers a significant advantage. If you sell stock in an eligible small business, assets under $50 million, after holding it for 5 years, you may exclude up to $10 million in gains from taxation. However, this exclusion does not apply to industries like health, legal, or real estate. Pass-through entities. Schedule K-1 reporting partnerships, S-corporations, and trusts report income via Schedule K-1. This form shows your share of the entity's profits or losses, which you then report on your personal taxes. K-1s often arrive late, increasing the risk of misreporting. Incomplete basis records can lead to overpaying taxes on income you haven't actually received. Ignoring a K-1, even if you think it won't affect your return, can lead to penalties. Real estate and REITs. Tax advantages and considerations. Real estate investors can deduct expenses, repairs, property management, to reduce taxable income. However, passive losses can only offset passive income. If you actively participate in managing your rentals, you may deduct up to $25,000 in losses against non-passive income. Real estate investment trusts, REITs, offer tax benefits. They pay out at least 90% of taxable income as dividends, reducing their tax liability. Investors can deduct 20% of REIT dividends under the Qualified Business Income (QBI) deduction. Master Limited Partnerships, MLPs, and Foreign Investments Master Limited Partnerships, MLPs, common in energy and transportation, distribute income via K-1 forms. Holding MLPs in IRAs or 401(k)s may trigger unrelated business tax income, UBTI. Investing through ETFs can avoid this issue. Passive foreign investment companies, PFICs, require complex filings, Form 8621, if holdings exceed $25,000. Noncompliance results in severe penalties. Choose an election method. excess distribution, mark-to-market, or qualified electing fund, carefully to minimize tax liability. The net investment income tax, NIIT, the 3.8% NIIT applies to high-income taxpayers whose net investment income exceeds certain thresholds. Married filing jointly, $250,000 single head of. Household, $200,000. This tax is in addition to regular income and capital gains taxes. Final thoughts: navigating complex investment income requires diligent record-keeping, proactive planning, and potentially professional advice. While tax software can help, it's crucial to understand the underlying rules and regulations. Ignoring these details can lead to costly errors. Tax planning is not just about filing. It's about optimizing your financial strategy year-round.